Hi Dean, I am struggling in staying in my winning positions in intraday. I am monitoring range extensions, one time framing, it stops for a while, then pullback happens, I exit from trades, then the trend continues. How to identify whether it is a reversal or a pullback? You cannot do that. And how to run the trend day? As I said, I have said this time and again. Why are traders facing issues, right? Why are they facing problems in their trading? Because especially discretionary traders like you and me, I am a discretionary trader. So discretionary trader has some freedom and there are some rules he has to follow. So where is the freedom? Freedom is in entry. Freedom is in choosing a strategy, what you want to do, right? You can choose the strategy of your liking, credit spread, debit spread, buying options, selling options, whatever. You can choose your entry points where you are going to enter. If you don't like an entry, if you feel that okay, this particular entry does not meet my criteria or I don't have the gut feeling to go with it, you have the permission to not take the entry. Or sometimes all the rules are not in favor but you feel you should take the trade, you again can take a trade. That is the freedom you have as a discretionary trader. The freedom goes away and all the rules comes in when it is time to exit. You cannot say that I exited the trade. Okay, earlier I used to believe that this also is in your control, but it's not. Exits have to be mechanical. If you want to sustain this uncertain markets, exits have to be mechanical. Sometimes you will enter, okay, and your system tells you to put your stop loss here, it goes higher, it tells you to move your stop loss here, market comes back, hits your stop loss and goes back up. Mechanical system, good, no problem, all right. But in majority of the cases what will happen is when you are told to move your stop as per your system, it will not hit. Market will give a deeper pullback, it will create a higher low and go higher, make a new high, you exited somewhere here because you panicked, your original stop loss was here which was not hit, and the market resumed its up move, all right. So you need to understand that if you are not using a mechanical exit plan, it is going to be very very difficult. Now what can you do? Let's say you want you bought here, your stop loss is here, don't move your stop loss unless it makes two swing lows. So it goes higher, makes first swing low, goes higher, makes another swing low, then you move your stop loss here, it makes another swing low, then you move your stop loss here. So you keep that two step behind, you're staying two step behind the markets, all right. And obviously you need to have a target. So it's not like you're always trailing your positions, no, there has to be a target. Like the first target that I always suggest is 1:1 reward to risk. So let's say you are taking a position in bank nifty, you're risking 50 points, the first lot has to go at 50 points. That's a rule. Then you bring your stop loss to cost. If you believe that this 50 points is not enough, I need to take a 100-point risk, no problem. As soon as it hits 100 point, you take out half your position, simple. Then rest of the position you can trail using this two step behind rule, or if it is a specific points from the top, chandelier exit as it is called. So let's say market comes here and you are putting a 100-point stop loss, so you enter here, 100 point is here, as the market goes here, this keeps climbing with the market, finally it gets it somewhere, okay. So that way you can manage the rest of your position. And 1:1 is the first target. Let's say there is some technical target at this level and you put your limit order there, it gets hit, you still have some position left, you trail the stop loss. If you get out of the trade here completely, that also is allowed. So the point here is that you can do entries manually, you have all the freedom, but when it comes to exit you have to follow a mechanical exit system, and it has to be logical obviously, but it has to be mechanical. If you start figuring out market is here, it's a spike, how high it will go and this and that, you are screwed. Where are we assessing the risk? We are trying to assess the risk and minimize it during entry, all right. Then I say we follow the continuous risk assessment framework. Yes, definitely. What kind of positions you are using? So let's say you're in a credit spread and you see certain things happening like lots of exhaustion, a potential for inventory adjustment break is there and your strikes might be vulnerable, you do the adjustments. But that is for credit spread. If you are doing short term trading, if you are doing intraday trading, you have to use a mechanical exit system. That's it. There is simply no other way of making consistent profit or sticking to your system if you don't have a mechanical exit. Because what will happen, every time, let's say you enter here and immediately your stop loss is hit. So you can work on your entry, you can try to understand this. But once the market starts moving and then you say, okay, I don't think this is working out, I will exit here, and then the market moves higher, or if it comes lower and you have unnecessarily moved your stop loss without following the rules too close to the market, it hits and then continues, then you simply have to bear the cost. There is absolutely no way you can come out of it. But if you have a mechanical exit system, it is logical and you have to follow it. Trust me, it seems, what happens, the problem is that we are making losses. If you look at the recent past, there are a lot of losses in the recent past. All right, not too far back, recent past. So last 10 trades, 15 trades, and there are multiple losses there, scratches there, this and that. And there are some trades where if you had followed the system, it would have given you big profits. So as soon as you go on to your next trade and let's say it makes some profit for you, you become scared. You don't want to lose this win. You want to win. You want to, bag this profit, and you want to feel good about yourself. Because see, if let's say you have taken 15 trades in last month and 10 of them were losses, right? And now you're taking the 16th trade. If it becomes a profitable trade, then you have a win. Then you are 10 versus 6. Let's say you had 5 winners before that. So psychologically, you would like to book that profit. But what happens, if we are not here to win more than we lose, we are not here to improve our win ratio from 40% to 70% to 100%. No, we are not here doing this. What we are here to take money out of the markets. All right. So you risk some money, you put some money in the markets, and then you take some money out of the market. We are actually trying to maximize the quantum of the profit, not the frequency of the profit, if you understand, right? So quantum of the profit will be maximized when you are holding your trades till your targets and you're making big trades. Okay, and if you get panic with a little bit of profit and move your stop loss too close, get out, that will not give you those big trades. All right, so trust the process. Okay, you have to trust the process. You have to trust the fact that you can read the markets well and you can enter well. Now you look at last 15 trades, okay, and let's say 13 of them were immediate stop loss hits. Like you entered the position and it never went into profit, it went lower and it hit your stop loss. Then you do not have the ability to read the markets correctly. So you have some areas to improve, all right? But once you, let's say, out of 15, say 7 trades are profitable and 8 are hitting your stop loss, you have a system here. Now the question only is, how much money are you making on these 7 trades and how much money are you losing on these 8 trades, right? Now, since we cannot predict the future, we cannot say how much money we are going to make on these 7 trades. So what you do about it? So when you study the markets, when you see like these are the references market is likely to tag, this is what the market is likely to do, you have to give market time. How do you give it time? You follow a mechanical exit plan or system or method or whatever it is, all right? And what you do on all 15 trades, you follow the mechanical exit plan. What you will find to your surprise is that maybe as you become good at entering trades, even if you win 4 trades only out of the 15, you will still be profitable on balance if you are making good enough profit on those 4 trades compared to the amount of money you are losing on the remaining 11 trades. All right. So the frequency is not so important as the quantum of the profit. That is how I look at it. So that is probably the reason for your problem of getting out when the market pulls back. All right. It's not your job to get out of the market. It is your system's job to get you out of the market if things go wrong. Whether you want to enter the market or not, that process, I don't like to make it a mechanical one because I like to be in control of my trading. So I like to be the one to decide whether I want to enter the position or not. But then when it comes to exit, I have learned the hard way that you have to have a nice exit plan, mechanical exit plan, which you have to follow without asking question.